You must have heard a lot about how the future belongs to cryptocurrencies, but did you know that even some of their ardent backers are now shunning this 21st century currency? Following the second largest bank collapse in American history last week, many individuals refused to touch cryptocurrency with a 10-foot pole. Understand why? I'll walk you through the largest financial institutional failure since the economic collapse of 2008 and how it is linked to cryptocurrencies. Let's get into it right away. Silicon Valley Bank is the 16th biggest bank in the United States. It has been shut down by regulators, and the Federal Deposit Insurance Corporation is now in charge of what it does. Just 3 days after Silvergate Bank said it was closing and going out of business, another California bank did the same. Silvergate and Silicon Valley Bank serve smaller niche areas the larger banks didn't pay enough attention to. Regular customers can't match the ease and safety of a big bank. So younger banks like Silvergate and SVB had to give their customers something that JP Morgan or Bank of America couldn't. Silvergate was started in 1988, but its growth really took off in 2016 when it started helping Bitcoin users with their money. Other banks don't like this market because cryptocurrency is often used for fraud, crime, and money laundering. Anti-money laundering and know your customer rules told banks that they had to make sure that any cryptocurrency-related funds that their clients had received were from legal sources. Because the money from selling cryptocurrency could have come from a well-timed purchase, it's hard and expensive for a bank to audit it. But it could just as easily have happened because of one of the many crypto rug pulls, or because of selling illegal things online. Silvergate identified a market gap and was prepared to provide financial services to this group in exchange for a charge. A cryptocurrency exchange platform named FTX, which used Silvergate to store its fiat reserves, was one of their most devoted clients. Fiat currency is a form of government-issued money that is not backed by a tangible good like silver or gold, but rather by the government that released it. The majority of contemporary paper currencies, including the US dollar, the euro, and other significant world currencies, are government currencies. On their homepage, the bank once boldly featured a review of their banking services by Sam Bankman-Fried, but that has since been taken down. Silvergate is accountable for assisting FTX's financial fraud and actively taking part in it. The Silvergate Exchange Network, or SEN, a major component of Silvergate Bank, allowed institutional investors, wealthy clients, and cryptocurrency exchanges to convert cryptocurrency into fiat money. Additionally, SEN offered a financing service that allowed customers to borrow fiat money using Bitcoin as security. The apparent stupidity of the Bitcoin loans was not the true issue at Silvergate. The issue was the cryptocurrency users whose own clients had lost faith in them. Although the bank generated revenue through its fiat exchanges and margin loans, it placed its faith in the cryptocurrencies it lent against. A fear was sparked when the price of Bitcoin dropped by over 70%. Due to the bank's vulnerability to unbacked debt worth billions of dollars and their affiliation with the fraudulent crypto platform, depositors began to withdraw their money and move into conventional banks. In order to protect depositors, our cryptocurrency bank decided to enter voluntary bankruptcy and begin the process of selling off its assets. If any funds held in fiat money couldn't be recovered, the Federal Deposit Insurance Company would cover the first $250,000 that account holders had in the bank. If they had more money on deposit, the bank might be able to come up with enough money to cover it during the closure process. The fall of Silvergate is a major news because bank failures are rare in America. However, Silicon Valley Bank, a much bigger bank that failed last week for various reasons, totally overshadowed it. The failure in this case was primarily due to an abrupt and substantial rise in interest rates. A bank's responsibility includes managing interest rate risk, which wasn't done in this case. Cryptocurrencies weren't a major source of exposure for Silicon Valley Bank. The service they offered to Silicon Valley startups and venture capitalists served as their competitive advantage over conventional banks. Because SVB had a venture capital and credit branch that made direct investments into funds like Sequoia Capital, Ribbit Capital, Spark Capital, and Greylock, it was known as the investor's investor, basically the who's who of Silicon Valley's institutional financiers. The bank also came up with venture debt, which is a type of loan for high-growth, early-stage companies that are too risky to get money from other sources. Traditional banks won't give money to any business because most new businesses fail, and can't show consistent profits or enough collateral. Silicon Valley Bank saw a need in the market for new business, just like Silvergate saw a need for risky cryptocurrency companies. One reason tech startups chose to bank with SVB instead of the big banks that wasn't stated was that it was a great way to meet new people. Startups, founders, and venture capitalists would meet at client events that SVB would host. This would give all of them great business chances. The bank would have assets worth hundreds of billions of dollars, most of which came from startups, which were their target market. Startups would put the money they had earned with SVB. Many of these new businesses were not yet popular, and some of them didn't even make money. The money in their account was the only thing that let them do anything. Silicon Valley Bank's biggest problems was making the most of the more than $200 billion in savings it had. Even though the bank offered traditional loans like mortgages, the only people who had a reason to bank with SVB were CEOs of new businesses, so they didn't make much money off of that. They couldn't get out enough loans for their venture debt desk to make money, even though it was bringing in money. They put all of their money into government bonds with small but steady returns. When interest rates started to increase, the bank's problem emerged. They had to start charging interest to the businesses that kept money with them in order to retain their deposits. If not, those businesses would switch to other banks where they could earn up to 4% of the cash in their company accounts. According to reports, the video streaming company Roku had $500 million deposited with SVB, which could have generated $20 million in interest annually for them. The bank failed because of a cost that showed up on both sides of its balance sheet. Even though its treasury was losing money, it had to keep interest rates for depositors at the same level. Between 2020 and the beginning of 2022, when interest rates on bonds were at all-time lows, SVB bought most of its treasury securities. A consumer of bonds will not be drawn to these treasury assets. If SVB needs to sell these bonds quickly, they will have to give buyers a discount to make up for the lower rate they will earn on their bad 2020 bonds. They could buy newer bonds that pay much higher interest rates. In fact, since VC investments have slowed down, they could buy right now from the government. As the bank's deposits began to decline, the bank was forced to sell some of its bonds at a loss in order to pay for withdrawals. If that happens frequently and the bank can't be reached, it's very dangerous. Venture financing came with the danger that they wouldn't have enough money to pay back advances. Last week, a group of venture capitalists who were keeping an eye on the startups they were funding told others about these problems. They told the companies in their portfolio to pull their money out of SVB. The result was a bank run. So what exactly is a bank run? When customers lose trust in a bank, they start to pull out their savings. This is what causes this to happen. Simultaneous, massive transfers risk the bank's viability. This raises concerns and puts the banking system as a whole at risk of spreading contagion from one company to another. At this point, the federal body FDIC stepped in to try to salvage the situation. The buyers were promised that they would get all of their money back. But FDIC also hinted that the crisis is widespread, and that Signature Bank, a major depositor for cryptocurrency companies like Silvergate, had also failed. With this, we wrap up this episode of Informed Investing. Do you believe this catastrophe will have a significant negative impact on the future of cryptocurrencies? Drop a line in the comments and let us know. Thanks for watching. Please subscribe to my channel and hit the like button if you enjoyed the video, so that you may be notified when I upload a new one.